Please welcome Scott Miller, founder of Greenhaven Road Capital, to Best Ideas 2016. Without further ado, I'd like to turn it over to you, Scott, for your remarks. Please go ahead.
Thank you. I'm really happy to be here today. Past couple of years, I've been a paid attendee and have really enjoyed hearing other managers and their ideas, and so it's fun to be on the other side of the equation. Given the time it takes to prepare these, this may be my first and last presentation for Best Ideas. I hope you enjoy it. Let's start out. I'll give you a little bit of background on myself and the fund so you know where I'm coming from. I have more of an operating background than many fund managers. I managed a manufacturing business and co-founded a company that manages Head Start programs for the federal government, and it's grown from 3 employees to now over 1,100 employees. So pretty big enterprise. I also have what I'd call a touch of traditional. So I worked at a private equity setting and for a long-short fund and have a fancy education. So a little bit of a mix, but I'm not the guy that did the 2-year analyst program at Goldman Sachs. That's just not me. What is Greenhaven Road? We're a long bias hedge fund. We're concentrated. We own about 15 positions, and the portfolio is a mix of, it's all equities. It's a mix of quality companies, what I call compounders, and special situations such as spin-offs and rights offerings, SPACs. And so, the portfolio tends to be split about half and half in the 2 camps. And I think today we'll look at an example of each of them. What do I believe? I come from a perspective that fundamentals really matter, balance sheet matters, cash flow matters, management incentives matter, and so I don't do a lot of technical analysis. I have a macro overlay when I invest, but I'm really a bottoms-up investor. I want to have an investment committee of one. I want to be a boutique. I want to be a small manager. I'm building exactly what I want here, and I often wonder about people's returns, right? There are a lot of articulate managers, and always when I'm listening to someone's presentation, I wonder if they made money in the past. So I put this slide on. You can look at it. My returns have been, pretty strong before launching the fund, as well as since the fund is launched. We've beaten, every major benchmark that I'm aware of. Past performance is not an indication of future performance, et cetera. Disclaimer, but I think I've had a pretty good track record of finding profitable investments. So, core thesis that we're going to talk about today is that there's some asset managers out there with strong balance sheets that are underappreciated by the market and provide compelling risk-reward opportunities. So, we'll do a 50,000-foot tour of asset managers, and we'll dig into a couple of names. So, at its core, I think asset managers are attractive businesses. They're very scalable, right? So an asset manager can double or triple assets under management, and they're not hiring 3 times as many people. They're not building another factory. It's just a scalable business. Recurring revenues are there. There's, typically 0 issue of collections. You just take the money out of the accounts for people. Super high margins, and just as my supporting evidence, if you need any more, 8% of the Forbes 400 are money managers. So there's some indication that asset management is an attractive way to make money. I have some cons listed here. It's a limited value proposition in terms of in aggregate, all the fees on top of it, there's a trend towards Vanguard and other things because in aggregate, it's not creating a lot of value for the end customers. I think there are certainly limited situations like Greenhaven Road where we can create a lot of value for people, but in aggregate, as an industry, it's not a huge value creation. There are limited barriers to entry. You don't need much more than a computer. It's a little bit of an oversimplification. And certainly we're sort of facing a trend where active management is out of favor. And we'll see if that lasts, but that is certainly a headwind for asset managers right now. So let's look at the basics of asset managers. PE is the dominant methodology, or people look at the AUM and apply a multiple to the AUM and the type of AUM. My core thesis in the examples I'll show you are that balance sheet is really ignored, and so people are looking at PE, assets under management. Some higher quality franchises get a little bit of a premium, and when people look under the hood, typically they're far more willing to pay for management fees that they view as predictable versus incentive fees which are variable. So it makes sense, but I'm going to argue there are situations where we're effectively getting the incentive fee call option for free. So I think the sort of shortcomings of people's valuation methodologies we can benefit from. And so as you look at asset managers, and we'll have a list at the end here, not all assets are created equal. Really, in particular, fixed income assets have a significant discount to them because they have lower margins. The other thing is people look at fund flows here. Fund flows matter as a predictor of future earnings. So people look at the ratings, the Morningstar ratings, et cetera, of the funds and try and figure out and extrapolate, okay, they're more or less likely to garner assets in the future. And then for places like the alternative managers that have lockups, obviously longer lockups are better because it allows you to better predict future earnings. So asset managers are a relatively straightforward group of businesses to analyze. So we're going to look at two businesses. One is Fortress Investment Group. This is my largest holding. It has not done well in the last 6 months, but I think it's poised to do well. And so, it is Fortress Investment Group is it's called an alternative asset manager. So we'll go into the areas of capital that they're managing. The glass half empty view on Fortress is that the macro hedge fund blew up, returns on private equity are poor, and the business is going nowhere. Okay, so I would argue that view completely ignores the balance sheet and the fact that insiders own half of this company, and that the underlying management fees are far more stable than I think people give it credit for. So let's look at this past year, 2015. It was tumultuous. Share price is down 35% or more. Mike Novogratz was in many ways a public face of Fortress. His macro fund was down 14 or 15%, and they ended up closing it down. So, it was a very small portion of revenues, but had a disproportionate amount of mind share. And they have something that they've created called permanent capital vehicles, and over the course of 2015, some of the share prices declined on those vehicles, and that makes raising future fundraising more difficult. I think those are great businesses, and so I'm not ready to throw the baby out with the bathwater yet. So it wasn't all bad in 15. The fact that Novogratz, the fund left, they were able to repurchase his 13% ownership in the company at a 17% discount to where it was trading at the time. So there was some benefit to that. Springleaf Financial was one of my big holdings for Fortress. It shows up in their cash and investments. It shows up in their private equity funds. Had a strong year, and their asset under management had the best growth since 2007. So, I think on balance, it was kind of an okay year from an operating and returns perspective, and a pretty horrible year from a share price perspective. And sort of as prices have declined, I've been a buyer. So let's see, what do we have here? Some key statistics about Fortress. $74 billion in assets under management, There's something called dry powder, which they refer to, which is effectively money that they can call down from their limited partners for future investments. So these are effectively commitments that investors have made to funds that they manage. That's another $9 billion. So again, I don't think the Fortress business is going away anytime soon. There's what they call gross embedded incentive, and so that doesn't appear on their balance sheet, but these are earnings that they have. These are profits that they have earned that will be realized when investments are sold. And so, but this is a $2.5 billion stock. $900 million of gross embedded incentive is, I would argue, particularly meaningful. There's also $2.85 in cash and investments, and they've bought back 30% of shares since they went public, and have a dividend yield north of 12%. So I think there's a lot of assets here that are hard to ignore. Let's look a little bit in more detail at the business model here. So there are really 5 areas that they break their management into. Credit and real estate is managed by a guy, Pete Brieger, who has great track record, $17 billion. He's putting up 15 to 20% returns. This is probably the crown jewel right now of Fortress. 2 other areas of note: private equity and permanent capital are managed by a gentleman, Wes Edens. Private equity returns have been mediocre. The permanent capital is, I think, a really attractive business. So the challenge with private equity funds typically is they have a 10-year life, and so you're sort of constantly having to fundraise to replace. It's effectively a melting ice cube, right? So after 10 or 12 years, the fund will go away, and so the idea of the permanent capital vehicles, they tend to have more of a retail investor, but these are vehicles that are in large areas such as transportation and infrastructure. They're permanent. Fortress manages these vehicles. They get an incentive fee and a management fee. So effectively the same economics of private equity, but they don't have a 10-year life. I think the name permanent capital is a little bit of a misnomer in that Fortress can be fired as the manager under certain circumstances. So I think you could argue they're quasi-permanent, but this is a really, really attractive business model. Now, I'm not saying I necessarily want to be an investor in the permanent capital vehicles, but I certainly like owning the manager of the permanent capital vehicles. And so they're in different verticals. Transportation and infrastructure is one of them. We'll show you on the next slide. We'll show all the verticals. But liquid markets is the hedge fund business that's taken its hits. But we have a call option on them creating future hedge fund products of merit. And then 33 billion of the 74 billion are in fixed income. And so this is sort of lower value assets. It's something called Logan Circle. Has a pretty good track record actually, and has been building assets, but it's not contributing meaningfully to earnings. Ironically, 33 billion in the fixed income world is sort of a subscale manager, but I think there's, this can be monetized if nothing else, and can grow over time. So these are the areas that Fortress manages. I think they're all pretty attractive. This is a slide that Fortress put out. This is from their investor presentation. It's a little bit dated in that the macro hedge fund and domicile hedge funds don't exist anymore, but I think the area to pay particular attention to are the permanent equity or permanent capital on the left side. And you see there's residential, there's housing, there's what's not on here is senior living also. That's a big vertical that they're in. And so this is a robust, dynamic business with they've launched a lot of new products. They've had a lot of success fundraising, and I think does not feel like a kind of down 35 or 40% business on some level. So part of my core thesis here is that the management fees are more stable than people appreciate, and so kind of have highlighted the management fees and incentive fees here, and you'll see that management fees are 59% of revenue and a greater percent of earnings, and these management fees are effectively locked in, right? So the incentive fees are whether if they make profits for investors, and those are more variable, but the management fees are based on assets under management, and so they're not going away. And so what happens is the management fees operate the core business. The incentive fees effectively provide bonuses for people, and so compensation is highly variable at Fortress and other asset managers. And so we have a situation where at Fortress they say, the first 32 cents of earnings are dividend are driven by the management fees, and so it's more stable than people appreciate. Here are, again, some more statistics on Fortress. Does not feel like a down 35 if you looked at these in isolation. Assets under management in the past year were up 13%, revenues up 3%, and distributable earnings were up 9%. So let's look at, I think, again, part of the thesis here is that a lot of analysts and investors ignore the balance sheet. So we closed on January 8th. There was a share price of $4.65. There's $2.85 in cash and investments. And then the embedded incentive fees after we take out taxes, after we take out compensation, et cetera, that $900 million, I think, conservatively is 80 cents. It might be more, it might be a little bit less. But, we take that $4.65 share price, we back out cash and investments, we back out the already earned incentive fees, and out of everything, we have a stub of $1. So that's far less than 2 times distributable earnings, and has a 50. That stub has effectively a 50% dividend yield on it. So, I think in this case, ignoring the balance sheet, it ignores a lot of the value and downside protection. So this is, when you own when your biggest holding is declining and someone comes out with a hold rating on it, you try and dig in a little bit. This is a Credit Suisse. This was their analysis of the alternative space, just as a point of reference. I have it highlighted in red here. They have it at 6 times cash earnings, completely ignoring the balance sheet, and that's a neutral for them, or a hold. That doesn't strike me as normal, but I think that's what makes markets, and that's where the opportunity is here. So, I think one takeaway here is the sell side is actually fairly bullish on earnings for Fortress. This is a 70 cent, 65, 70, 80 cent earnings are the consensus estimates, and I think that's driven by the strength of the management fees. So, this is part of the opportunity. So I think this could be a double. I don't think it takes any imagination or a lot of imagination to see it doubling. So kind of came up with 2 methodologies to put it as a double. So applying a 15 multiple on the very stable base dividend gets us kind of actually above the current share price. Add in cash and investments. Let's give that a haircut just to be conservative. The embedded incentive fees, and then the performance fees, excluding Logan Circle, the fixed income. Put a six multiple on those and haircut those from the historical numbers, et cetera. We put in Logan Circle at 1% of AUM, and we're at more than a double. I think the other way to get there is if the dividend yield drops to in the 6% range, it's more than a double also. So I think it's a really attractive opportunity. We can. This is on the last earnings call when actually I think shares were about 20% higher. The West Eden that runs the private equity portion of the business, called the valuation ridiculously low. He outlines in this quote a couple of ways that they can fix it. I think there's the opportunity. They have done buybacks in the past. They can do a tender offer. Management owns effectively half the company. A $1 share price increase for West Edens or Pete Bricker, translates into $50 million plus in terms of increase in their personal net worth. They have a lot of reasons to figure this out. So that's Fortress Investment Group. The next one I want to talk about is, much less known or out there. There's a Joel Greenblatt quote that I love that I have up on the screen here. If you spend your energies looking for and analyzing situations not closely followed by others, informed investors, you greatly increase your chance of finding bargains. Okay, so that is what I'm arguing we're doing here. The company we're going to look at has no sell-side analysts, nothing on Seeking Alpha, nothing on SumZero, nothing on Value Investor Club. Seeking Alpha, if you look up a company there, it shows how many people have it in their portfolio. 28 people have this company in their portfolio. 1.1 million people have Apple in a Seeking Alpha virtual portfolio. So, this is just off the screen here. Okay, so company's not doing anything to get the word out either. We can get into why that is, but they've done no conferences, no presentations, no conference calls, and quite frankly, they're unresponsive to email. So I would further say that if you needed more evidence, if you Google the company name and comes somebody else. So I would say we're treading right now. So the name of the company is Associated Capital. It's a spin-off out of Mario Gabelli's shop, Gamco. So what happened over the course of 2015 was Gamco looked and said, hey, we're trading at the same multiple as our peers on a PE basis, but we have half of our market cap, or more than half of our market cap, in cash and investments. And so they decided to do some financial engineering and split the company and put the cash and investments and other assets into the new company, which is Associated Capital. Oftentimes in spin-off situations, there's something called a garbage barge, where you put all of your toxic junk into the spin-off company, load it with debt, push it off, and say, good luck, guys. I really don't think that's the situation here. Mario Gabelli retained 75% ownership of the new company, Associated Capital. He put his son in as CEO. They stuffed it with cash and assets, which we'll look at in a second, as opposed to putting as much debt as possible on it. And they announced a massive buyback. So I think this is really interesting, off the radar company. There's some basics here. This is a small cap company, $750 million market cap. Gabelli owns 75% of it, so the free float here is rather small. But I think that the downside here is very, very limited, as we'll get into in a second. So the glass half empty here is, I think, most likely related to Mario Gabelli, but I also think it's just not on anyone's radar screen. And so my personal view is we have what I think is a growing dollar selling at a significant discount. So let's look at, remember, this is a $29 and change stock. Let's look at what is inside of this, okay? There is $14 a share in cash, right? So they took all the cash that was in Gamco and effectively stuffed it into Associated Capital. They took all the investments, $300 million plus of investments, stuffed it into associated capital. And they also gave Associated Capital $150 million worth of shares of the old parent company, GAMCO. They did a situation where Associated Capital lent money to GAMCO to be paid back over 5 years. So there's a $250 million loan to GAMCO in here, which is a little bit hard to get your head around. This company that kind of quasi didn't exist was able to lend the parent $250 million, but that's what happened. And then there's some receivables and liabilities, and you net all this out, and you get to a little over $40 in real hard assets here. This is not a there are these business development companies, other companies where you look at the balance sheet and you're like, not really sure. It says it's 40, but I'm not really sure it's a 40. I think in this case, it really is. It's not that hard to value. There's a fair amount of transparency here. They did first thing they did as a public company was to announce a 500,000 share buyback. If you look at the average trading volume, et cetera, I mean, this is a month plus worth of shares if they actually execute on it. And really, at these prices, it's the first. I have 35. It's really the first 40% of appreciation will get us to adjusted book value. And so I think we have pretty limited downside with the combination of the buyback and the underlying assets here, and the upside again gets us to book value. And so this is a situation where GAAP matters, and I hate to get into the vagaries of accounting, but oftentimes the situations I like are things that will screen poorly, and so this will screen as having a book value of 30 when it has an adjusted book value of 40, and it gets down to the vagaries of accounting, and effectively the loan to GAMCO, which is, if you look at GAMCO and their earnings, et cetera, I would argue is certainly money good. It does not appear as an asset, so they will get paid back $250 million over 5 years. That's not showing up as an asset on the balance sheet. You can see on the screen it's showing up. The highlighted piece, it shows up in the equity section, and that's just because of the details of GAAP, which you can read for yourself. And so we don't have to get into whether it makes sense or not. It's a reality. That's how they're reporting, and so that's, I think, a big piece of the opportunity here. And so I would also argue there's more, though, like the late night talk show or the late night infomercial. But wait, there's more. There's a $1 billion hedge fund that was given to Associated Capital as part of the spinoff. And so what the logic was that they weren't getting any value for it in terms of the GAMCO valuation, and it was a little bit different than the mutual fund business that they had. And so they put it into GAMCO. And so the assets have been pretty steady there, and I think we'll dig into it in a second. But there's a second operating business, which is an institutional research business, has about $10 million in revenue. It's just not core to the thesis at all. And then the other piece, I think there's even more. The desire is to have a seeding business for GAMCO, and that's, I think, the logic behind stuffing it with cash, the loan that would get paid back, and the GAMCO shares which can be sold. So, they have an enormous pile of cash that they can seed investment managers with, and so, seeding is actually a great business, in my opinion. So the general idea in seeding is you provide someone with capital that gives them enough scale to attract additional capital, so they really want that first, the first 25 million or whatever is the hardest for people to get, and you help them get that initial capital, helps cover some of their operating costs, et cetera. You return whatever that you get, whatever the normal investment returns are that a normal investor would have in a fund, right? And so if you see the right manager, you should get nice returns on your investment, but you also get a revenue share on other assets they raise, and so you effectively own a piece of the business. So if they can seed the right emerging managers, it is an incredibly attractive business. Now, they don't have a long track record of seeding, so you can discount it some, but I would say they are hunting in some very attractive waters here. And again, we're buying this for 70 cents on the dollar, so we're not paying a huge premium for the seeding business. And so I think they're under earning as a business, right? So the hedge fund has had I would say mediocre returns. The merger arb strategy they run, they've had, it's just been a tough couple years to be in that strategy, and even the sort of best merger arb funds are putting up 3, 4, and 5%. So the incentive fees for them are quite low, but the reality is $1 billion hedge fund can make substantial incentive fees, and they haven't. Their returns were sort of sub 1% last year, so the incentive fees were effectively de minimis, but that doesn't necessarily have to be the case. And so I'd argue they're potentially under earning there. Cash is earning nothing over time as that gets deployed, if they can do it at all reasonably well. And Mario Gabelli is a guy who started with nothing. He's a billionaire now. He has a pretty good history of deploying capital well and compounding. And so cash is earning nothing, but we're not going to do, well, hopefully we won't do worse than that. The investments, the last quarter they lost money on. That was the quarter ending September 30th. That was a pretty tumultuous time in the markets. Historically over time, investments have done well, and they have a loan paying 4%. I would say that's okay in this environment, but it's not impossible to see them doing better than that over time on that $250 million as it comes back through seeding or whatever. So we look at it here. The pro forma. This is the pro forma last quarter is the first column. They lost 27 cents a share. If we make a couple of modest assumptions about, and this was in a period where equity markets were down 7 or 8% in the quarter, and again they have all this cash and other things that aren't earning anything. And so if we make modest assumptions around returns at the hedge fund and for the investment returns, I think it's pretty easy to have this company earning 25 cents a quarter, growing $1 plus a year. Again, this is for something we're buying at 70 cents on the dollar. My main point here is that this is not a melting ice cube. This should be a slowly growing enterprise, and I would argue that instead of trading at a 30% plus discount to book, it should trade at a premium to book. And so I think any conversation of associated capital, most people have no idea what it is. You look at them and they go, oh, okay, what? And then you say, oh, it's spun off from Gabelli, and you can get into a conversation about Gabelli. And so I think it's just worth giving you a heads up on some of the Gabelli issues. I'm long. I actually have a lot of respect for the guy. He has a very lucrative deal. It's fully disclosed. You know about it going in up front, but he gets 10% of the pre-tax profit. So you'll see Mario Gabelli has done very well for Mario Gabelli. His initial investors in Gamco sued him. Mark Gabelli, his son, has had some issues related to the SEC and possible favorable treatment for a hedge fund. This is 7 or 8 years ago. Most of the charges were dropped. Some of it was settled. I think it's I don't think it's particularly material, but I want to raise it for folks and make them aware of it. And Mario Gabelli has had some outside activities from Gamco to effectively try and benefit Mario Gabelli as opposed to his shareholders. And so, I think you should be aware of them. You can Google them. I think the real headline here, though, is that he owns 75% of it. He put, kind of the crown jewels in many respects into associated capital, and, we're getting something with $40 of book value for 30 in large part because no one's paying attention, and the vagaries of GAAP accounting and, we'll see. I think Mario, it's very accretive to them to buy back shares at this price, and I think there's a lot of downside protection. So this doesn't have as much upside as some of the other names that I like to invest in, but I really like the risk reward and the entire setup here. And so that's the second idea. I think in general, just for folks as they approach this, there's a really large universe of investable companies out here. Put together a short list. This is U.S. It's not actually all of them. They're international, and I think in general this theme of underappreciated balance sheets will pop up in a number of the names that you look at, from alternative asset managers. Virtus has really substantial cash and investments, et cetera, and so I think it's an interesting hunting ground, and this is a little bit of a map for folks to look at it. I have one more idea that is not really ready for public consumption. It's really only appropriate for PAs and small funds. It's a small company, limited liquidity. I am in the process of doing some buying and finishing my work. I don't have a write-up on it. But if folks have thought these other two ideas were interesting and want to both get my quarterly letters, but also get I'll send it out when it's ready. It's just not ready right now. It might be 3 weeks. It might be a month. I'll send out the idea. I have a website, greenhavenroad.com. You can see there. Go connect. A little form to fill out, and just say, hey, please forward me the third idea from Best Ideas, and I will. I'll drop you a note and the thoughts when the time is ready. But again, that'll be, if you're running $3 billion. Save yourself the time. You don't have to go to the website. But for the people who have PA accounts and kind of are interested in asset managers as a class, et cetera, I'm happy to share one more idea when it's ready. So this is how you can reach me. Happy to take questions and follow up, et cetera, as people dig into these ideas.
Scott, thank you so much for sharing your time and sharing your idea. I'd like to actually have a conversation about you before we talk about your ideas, if we could. I understand that you have a very fair incentive and fee structure with your fund, which is non-traditional. Could you please elaborate how you structured your own fund, please?
Yeah, so really modeled after the Buffett partnership model, and so my incentives are really around delivering returns for myself and investors versus just gathering assets. And so I have a 6% hurdle rate, which is pretty high, and then we take a 25% incentive over the 6. And we're in the process of changing our fee structure a little bit, but for folks that make a meaningful time commitment to the fund, I don't charge a management fee. So I am really just incented and wake up to try and deliver returns.
And the obvious
I think the other thing also just worth noting is that this is effectively my net worth in the fund, and so I am eating my own cooking every day, and I don't promise a smooth ride up, but I'm taking every lump on the way down and enjoying the benefits on the way up as well.
Yeah, and that's I think the follow-up, where having zero fee sometimes create the risk of keeping the lights on if there's a dry spell. So could you speak to how well the business itself is capitalized, or you are capitalized yourself, to whatever degree you feel comfortable disclosing, please?
Yeah, so I have a lot of operating experience, and I did pretty well investing. If you just kind of look at the returns before I opened the fund, the decision to open the fund was based on putting up some pretty ridiculous numbers over. It goes back even further than I was able to document kind of on that first slide. But so we're in pretty good shape for. I don't know. We can weather a 10-year storm or something. So we're in pretty good shape. It doesn't make it, fun to go through a dry spell. But we're here for the long haul.
So
it's my vehicle to manage my personal wealth, and I opened it up initially really just to friends and family who had been asking me for ideas or to invest their accounts for them, and I created this as a structure to do it in kind of a legal way where I also, realized some of the upside, and, it sort of evolved over time, and it's growing, and sort of opened it up further.
So I'd actually like to pivot to discuss the actual ideas, and
right.
It seems like you've chosen to build a firm which is very fair to investors with a very low fee structure. It sounds like the ideas you're presenting are largely based on having fee-based income, and arguably fees across the industry will come down over time as opposed to go up further. So how do you think through long-term trends that fees are coming down, they're not going up?
Well, in the case of Fortress, right, we have the permanent capital vehicles, those fees aren't going down. The fixed income fees are already on the low side, and so on the credit funds where they've just crushed it in terms of returns, people have been lining up to invest. So there may be some fee compression there, but if you can deliver returns, I think we're going to be okay there. Associated capital is really less around the fee component as opposed to just it's completely under earning right now, and we're just buying it at such a discount that I think we're okay there. I think the fee structure decline, it has been gradual. I think the bigger issue, quite frankly, is the trend away from active management, which I think Murray Stahl has done a lot of work and made a pretty persuasive case, and that might not end so well for folks. And I'm not convinced that pendulum won't swing back a little bit at least one more time.
And then when looking at an investment fund or an investment business, oftentimes the only expense in the business is SG&A, and it's actually salary. It's not really G&A. So could you speak to how these companies manage their SG&A line item, and if you think the SG&A is going to trend higher or trend lower over time?
Yeah, so with associated capital, I think on some level we just don't know. The SG&A has been de minimis. It should actually grow as they build out their seeding business. But for Fortress, there's a very large variable component to it, and so effectively, as the incentive fee rises and falls, the compensation line rises and falls, and we end up sort of paying out 40 to 50% of the incentive fee as comp, and so it's highly variable, which is nice because it lines up with the revenue streams that are highly variable as well.
And my understanding is you run a concentrated book, and you're very thorough in your research, and I presume it's rather difficult to find terrific ideas in this environment, which might suggest we're in the later stages of a bull market, given the difficulty finding cheap and good. How do you think the concept of a bull market slowing down could or could not be relevant to owning investment funds for the next 3 to 5 years?
It's absolutely a headwind. I think, in the associated capital side, half the price is in cash, right? Another $250 million is in a loan, which is money good. There's the GAMCO shares, which, you got 4.3 million of them. They may get some haircut as GAMCO has some challenges in the sort of bear market thesis that you're describing, and they have some investments, $300 million in investments that, may take a $20-30 million haircut. But again, you can take out your red ink and scribble it all over associated capital, and I don't think you're getting to adjusted book value, below 35, say, and so you're still getting 20% return, just getting to to adjusted book value. And I think the other piece there is that for the seeding side, a bear environment, a bear market is probably arguably a better time to be seeding, right, putting money to work, than a frothy bull market. So, on the for Fortress, they're a diversified asset manager, so their PE funds, you're really concerned about a couple of holdings there in a bear market. I'd argue that Nation Star is pretty beaten up already, but that's one of the holdings that you care about. Another is OneMain, or what was formerly Springleaf, and that also is taking a bit of a haircut. Obviously, could go down more, and then there's a huge Florida real estate play in there, and so that's in the cash and investments and private equity side, but it also creates opportunities for investment, and so these are a little bit of you give with one hand and take with another. In a bear market, I think there's a very good chance that they pull down a significant portion of the dry powder related to the credit funds as junk bonds spreads widen, et cetera. So, that goes to increase management fees, and so they're diversified. We care more about the management fees and the incentive fees. Comp is, would I want to work at Fortress and have all my comp related to incentive fees in the next 3 years? Maybe, maybe not. But I think at this price, stub value of $1, I think it's not riskless, but I think we're getting compensated to take the risk.
Well, Scott, thank you so much for sharing your time. I also want to point out that I happen to particularly respect that you prefer to focus on investing and you prefer not to market as a full-time job. So we are particularly grateful to showcase your work. We also respect how much you focus your life around delivering returns and not going to other conferences and other marketing galas. So thank you for being here with us. And anyone who's listening is welcome to reach out to Scott privately at greenhavenroad.com. And thank you for being here. Have a great day.
Thank you.